Unity reported their latest earnings on Thursday after the market closed. A small miss on EPS, a beat on revenue estimates, but the big news here is that they announced a new CEO. At the time of making this video, stock is down around 2% or so. Of course, as you know, that might change throughout the day. Has a market cap of around $9.4 billion, forward PE 34.3 times, EV to sales in the next 12 months 6 times. If you look at what the analysts are expecting in the coming fiscal years, in fiscal year 2024, they will take a hit, top and bottom line, full restructuring, etc., etc. But then we're expected to see some reacceleration in growth, especially top line growth for fiscal year 25 and 2026. For 2026 EPS, they are seeing a small decline there. But of course, with the new CEO, with the full restructuring, things will change with those estimates. So stay tuned. Now, you know, I've been covering Unity for quite a while. You know that I previously was a shareholder. Probably plenty of you were shareholders as well. And then we just said we just can't be shareholders of this company anymore. It's impossible to continue to follow and support the management, the CEO, and the way they were operating. Fiasco after fiasco, it just didn't make any sense anymore. Then, of course, came in the interim CEO, full restructuring. Okay, maybe they were going into the right direction. Now they found a new full-time CEO. Again, restructurings are happening, but maybe now with the new CEO, with everything behind them, maybe things can get quite interesting, because remember, this is a duopoly. It's Unity and Unreal. And in mobile, Unity is still the strongest out there, which is also one of the main reasons why they keep on surviving. If there were plenty of other players in their market, I don't really think that we would have seen Unity survive for this long after all the mistakes that management have made in the past. Of course, I can be completely wrong. Do let me know down in the comment section below. I also have a question towards the end of this video with regards to dilution. Maybe some of you might help me out there. If you enjoy this type of videos, leave it a thumbs up, subscribe if you have not. Really appreciate that. If you want to support me even further, do check out the link down in the description and in the pinned comment to get the top 10 best stocks to buy now, or go to fool.com/couchinvestor. Thank you very much. I first want to start off with a stat here from Unity's own gaming report. So they said here that as in-app purchases average revenue per daily active user declines, in-app advertising is on the rise. Studios are broadening their mix of in-app advertising strategies, and games using both rewarded videos and offer wall are reaping an increase of 4% and 2% in day 7 and day 30 retention, which is great because they also have the advertising side of the business. And we know everyone that adds advertising, at least a good way of adding advertising that doesn't annoy a viewer, a gamer, is going to reap the benefits from that. So that's pretty good to hear. So we closed the first quarter with results in line with expectations. The portfolio and cost reset that we started a few months ago is completed. While we will always look for efficiencies, our attention turns to accelerating revenue growth while operating at attractive profit and cash flow margins. We are pleased to welcome Matt Bromberg as Unity's CEO and President and member of our board of directors effective May 15. Matt brings over 20 years of experience in gaming, having served as the Chief Operating Officer at Zynga, where he played a key role in the company's turnaround. Before that, Matt held multiple leadership roles at EA, yes, exactly the same company as the last CEO of Unity. Now the interim one, Jim, will become Unity's executive chairman of the board. Then here they talk about the huge opportunity. The gaming industry generates $260 billion in annual revenue, with mobile being the single largest market. So of course, like I said, it's a huge market. They're a huge player. I think there's quite a lot of opportunity there, but I do understand that investors, myself included, do want to see some improvements before again jumping into these waters. And so, revenue for the first quarter was $460 million, down 8% year over year, driven primarily by their portfolio choices. Revenue in their strategic portfolio was $426 million, up 2% year over year. This compares to guidance of between $415 and $420 million in revenue in that strategic portfolio. As for Create Solutions, revenue from their strategic portfolio in the first quarter was up 17% year over year to reach $133 million, up mostly driven by growth in subscription and strategic partnerships. Their core subscription, excluding China, only grew 13%. As for Grow Solutions, revenue from their strategic portfolio in the first quarter was $294 million, down 4% year over year. They are saying that they're making progress strengthening the performance of their mediation platform and ad networks by better leveraging their data to improve the efficiency of their models. Now, of course, now with the rise of AI, efficiency, etc., they better figure this out quite fast. During the first quarter, revenue from their non-strategic portfolio was $34 million, down 59% year over year as a result of their portfolio reset, which included exiting non-strategic businesses, which they announced, I think, a quarter or two ago. They expect revenue from their non-strategic business to continue to decline going forward and be in the single digits at the end of the year. As for the profitability side of the business, GAAP net loss for the quarter was $291 million. The net loss this quarter includes $212 million of restructuring costs and a $61 million gain related to their convertible note repurchase. Excluding these charges, GAAP net loss would have been $141 million. And of course, that's an improvement from the GAAP net loss of $254 million the year prior. As for adjusted EBITDA for the quarter, that was $79 million compared to adjusted EBITDA of $29 million in the same quarter last year. Then, if we scroll down here, a couple of announcements, business announcements, etc. I want to focus a bit on the VR, AR space. So they're talking here about the Vision Pro and Meta Quest 3. So looking ahead, we see opportunities for developers to leverage our capabilities in mixed reality and spatial computing with devices like Apple Vision Pro and Meta Quest 3. They say here, 50% of the week one must-play Apple Arcade games for Apple Vision Pro were made with Unity. Now, whether you believe it or not, I do think that the next generation of, let's say, gaming or at least digital social interactions are going to be made thanks to these devices here. The Meta Quest 3 or 4 or 5, whenever those will come out, and potential a cheaper, better Vision Pro in the future. Then as for guidance, for the second quarter, they're guiding strategic revenue to $420 to $425 million, down 6 to 7% year over year. They're guiding adjusted EBITDA to $75 to $80 million for the total company. As for the full year, they're confirming their strategic revenue guidance of $1.76 to $1.8 billion, which would represent an increase of 2 to 4% year over year, and between $400 to $425 million in adjusted EBITDA for the total company. They expect to exit 2024 with adjusted EBITDA margins of 25%. Now, my question here is with regards to fully diluted shares. So they expect 478 million fully diluted shares at the end of the second quarter and 492 million at the end of the fiscal year. Now you might say, okay, what's the question here? Well, remember those numbers, right? 492, 478. But focus on 492. Because if we scroll down and we look at the number currently, I mean, it's going to be quite an increase year over year. If I can find it, okay, it's right here. So if you look at the weighted average shares used in computation of basic and diluted net loss per share, I mean, that means that it's going to increase by around 30%. 30% dilution? Am I missing something here, or is this business as usual? Do let me know down in the comment section below. If I missed something, I will pin it in the comment section. Now, the stock currently, it's again at levels that are extremely low, one of the lowest ever for this stock. But of course, I mean, even when the stock was higher, the business was doing better. So saying right now that the stock is cheaper than before may be the price of a share, but the business itself definitely not the cheapest it has ever been. Because remember, previously the business was actually performing quite well. But now I think risk-reward wise, if they can turn it around, if the new CEO means business, then yes, maybe there is quite an opportunity here. I'm still waiting on the sidelines. Although I like the business, I'm still not willing to take the risk right now. They need to convince me a quarter or two that they are back on track. Currently, they are sitting under the 20, the 50, and the 200-day moving average. RSI is pretty low. If you want to know where the 200 sits, it sits at $31, the 50 at $26.3, and the 20 at $24.67. So that will be it for this earnings review. Of course, do share your thoughts down in the comment section below. Are you still a holder? You're still on the sidelines? You don't want to touch this company anymore? Let me know down in the comment section below. If you enjoy this type of videos, leave it a thumbs up, subscribe if you've not, and I'll see you all in the next one. Bye-bye.